Welcome back, students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems from the digital study guide for chapter 9 exercises, the group B exercises. Let me get to the right slide here. Okay, note, accounting is about understanding the concepts, then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. And before I get into the problem, this is, I just took a quick glance at the next problem, but now, this is important that if you don't understand the theory, right, because we're working on bonds and they're getting more and more complicated, the theory stays all the same, but the application aspect of it is different. You'll find that in the problem we're going to work, the way the information is presented in a different fashion or a slightly different way from what you saw in the textbook, right? So even if you just read the textbook and you don't understand the theory, when you see a new problem, if you don't have a complete understanding of the theory, then you're not going to be able to work the problem. So make sure you go back and understand the theory. So with that said, let's jump to 9-34. All right, my pen, and it says here, Peterson Machine issued a $475,000 10-year 7% bond on January 1st. Okay, so on January 1st, we don't have to worry about accruals, all right, at the end of the year. They pay interest January 1st and July 1st and amortize any discounted premium by the straight line method. Peterson Machine can issue its bond payable under various conditions. Right, just as a quick aside, as I was reading this, I mentioned this in the theory that when it comes to amortization of the discount or the premium, for the most part, the textbook is using a straight line method, but it doesn't mean that it can't use other kinds of methods. So, that's what I mean by understanding the theory. If you've been just kind of like working along with a straight line method, and then all of a sudden it comes along and it says, let's use a double declining balance method. Well, what do? You're not going to have an example of it in the book, okay? You have to understand the previous theory and concepts in order to work through problems, okay? And so, A, we're going to issue at par value. B, issuance at a price of $460,000 when the market rate was above 7%. And C, issuance at a price of $493,000 when the market rate was below 7%. Journalize the issuance of the bonds and first semi-annual payment for each situation, and then which conditions result in the most interest expense. Right, so as I work through these, I'm going to pause the video and make sure that you write down whatever you need to, because I will be erasing the information. All right, so A, we're going to issue at par value. All right, so on January 1st, we're issuing at $475,000, a 10-year bond at 7%. So when we issue it, what do we get? All right, we get cash. So we debit our cash, and that is for $475,000. And we have to pay it back, so debits have to equal credits. And that means we're going to credit our bond payable for $475,000. Okay, come on, there we go. So that is the issuance. And now we have an interest expense on July 1st. So on July 1st, we're going to pay out, cash because of the coupon on the bond, the semi-annual interest payment, right? And we have to calculate that interest payment, so it's $475,000 times the interest rate of 0.77%, 0.07, and times 6 months out of the year, right? And when we do the math of 475 times 7% times 6, and then we divide by 12, we end up with $16,625. So we're going to pay out $16,625 in cash, and that means we're going to debit. Well, what are we doing? We're paying interest, so we're going to debit our interest expense for the $16,625. Okay, so pause the video and write that down if you have to, okay, because I am now erasing it. Okay, so the next one is a issuance at a price of $460,000 when the market rate was above 70%. Okay, now remember, this here is a $475,000 10-year 7% bond. Now we're going to issue it at a price of $460,000 when the market rate was above 7%. Right, so how much are we getting? Right, well, we're going to get cash, and that means we're going to debit our cash for $460,000. And of course, we're going to credit our bond payable, right? Oops, we're going to credit our bond payable for the $475,000, right? Because we're getting cash of $460,000, but the value of the bond is $475,000. We have to pay the $475,000 at maturity 10 years down the road. Okay. Now, to make it simple, right? Debits have to equal credits. So we're going to back into the last half of the entry. So debits have to equal credits. That means we have to debit something else. And since par is 475 and we're getting 460 for it, that is a discount because it's less, right? So we're getting it at a discount on the bond payable, and that the difference between the two is $15,000. Okay, so that is the issuance of the bond. Now we have to calculate the interest that we're going to pay on 7/1. Okay, so on 7/1, we know that we're going to credit cash. However, we don't know how much, all right, for the simple reason we're going to have to calculate our cash, all right, I should say. Right, so the first thing we have to do is take the 75,000 times the 7% times the 6/12, and that gives us our $16,625. So we know we're paying out the $16,625. We also know that we have this here discount. Okay, as I said that, let me back up just a little bit. I had said we didn't know what our cash was. Okay, I should have said we don't know what our interest was. Okay, because we're paying out our interest, right? We're trying to figure out what our interest expense is going to be, and we don't know what that is just yet, right? We know that we're going to pay the $16,625 because that's the coupon on the bond, right? And that's that calculation right there. But we don't know what the interest expense is because we still have this discount on the bond payable, right? That discount on the bond payable we have to amortize, right? And when we amortize it, it's 15,000 divided by, this is a 10-year period and there's 2 payments per period. That means 20 periods. So we're going to amortize it since we're doing this straight line. We take the 15,000 divided by 20 and we end up with $750. Okay. So we're going to credit our discount on the bond payable for the $750. Remember that discount right there on the bond payable, right? We're over the course of time, we're expensing that to ourselves. Okay, it's just like accumulated depreciation. So at the end of 10 years, the balance in the the balance in the discount on bond payable started out at 15,000, and over the course of 10 years, that balance gets slowly reduced down to zero as we expense it, semi-annually, along with our interest payment, because we're treating that discount on the bond payable as an interest expense, right? So when we know what we're paying out in cash on the coupon, and we know how much we're amortizing that discount, then debits have to equal credits. We add the two together and we back into the amount of $17,375. Okay, and that is our journal entry for the discount. Right? So pause the video and copy all of that down because I'm going to erase it. Okay, so we're back, and that was the discount, and pretty much the premium is just the opposite. All right. So if you're into the idea of, oh, well, let me, I have this here, I have the journal entries for the discount written down. Now all I have to do is just work it, as an opposite, two sides of the same coin, accounts payable, accounts receivable, prepaid, unearned. A lot of accounting is like that, okay? You can look at those entries and sort of make like the opposite entries, but in the real world, you're not going to have a discount and then also have a premium at the same time. You're going to either have one or the other, all right, or par, all right? You have one of three choices. So you're not going to have something where you can, quote unquote, look at and, do the opposite of. You're going to need to figure it out from scratch. So for the issuance at a price of $493,000, we know that we're going to get in cash $493,000. So we're going to debit the $493,000. Okay, we know that we're going to have to pay out, so we're going to credit our bond payable, and what we're paying out is the $475,000 10 years from now, and the difference between the two is our premium, because we're making $18,000, right? So premium on the bond payable for $18,000. Okay, so debits have to equal credits, right? Again, par is 475. We're getting 493. That's a premium. Right? So that's how we make the journal entry for the premium on the bond payable. Now, on 7.1, again, we have an interest expense, right? So, we calculated the cash that we have to pay out, right? So we're going to credit our cash of $16,625 for when the person brings in, takes the coupon, all right, and cashes in the coupon, right? So they're going to get that interest expense. We know we're going to debit our interest expense, but we don't know how much that is, because we also have to take into consideration the premium, just like we had to take into consideration the discount, all right? So we know that debits have to equal credits, so we'll debit our premium on the bond payable. And that's, just like on the discount, we're booking the premium at $18,000 now, and over the course of the 10 years, we're going to amortize that 18,000, which means we're going to reduce it, just like the book value of an asset. You know, you have an asset, and then you have your accumulated depreciation, which decreases the value of the asset. All right. Well, the same thing is happening here with the premium. You know, we're booking it at 18,000, and over the course of 10 years, that value is going to go down to zero. So that's why, you know, you have a credit to premium and a, you know, debit to premium in order to reduce that value. And the amount is 18,000, and we're going, since we're using the straight line, and it's 10 years, and semi-annual payments, 20 payments. So 18,000 divided by 20 is $900. So our premium is $900. And now we can figure out the interest expense, because debits have to equal credits. So 16,625 plus 900 less 900 is $15,725. Okay. Right. Notice here, 16,625, that is a credit. We're going to debit $900. All right. The difference between the two is 15,725. Okay. For the discount, you know, we added them together. Right. We had a debit of 16,625, and we had a debit of 750. I'm sorry. Yeah. We had a debit to cash for 16,625, and I'm sorry, not a debit, a credit. A credit of 16,625 and a credit of 750, and that's why we ended up with 17,375. But in this case here, we have the credit for 1625, but we have a debit, so we have to subtract the two, and we end up with the 15,725 as our interest expense. So don't just automatically add those two together and think that that's the amount, because then you can write it in, right? And some people will do this. They'll go 16,625 plus the 900 and get 17,525, and they will do this. They will write in the 17,525 and just call it quits, and think that these debits equal the credits, okay, which they do not. All right. Just because they're just working it mindlessly, okay, they didn't take into consideration, you know, whether these are debits or credits that they're dealing with. So just be aware that that is a common mistake, and that the amount should be 15,725. Okay, so that's it for C here. Okay, and now it says, which condition results in the most interest expense for Peterson tool? Explain in detail. Okay, so we had 17, let me do it in blue. Okay, so we had, right, here's par for 475,000. The premium is at 493, and the discount was at 460. Okay. The amount of the interest expense on the discount was 375, and on the premium was 15,725. Okay, so it says, which condition results in the most interest expense? The discount. For premium for Peterson machine tool, explain in detail. Right. Now the book says, the answer in the book says, the discount price of 460,000 results in the most amount. All right, so the discount results. It says Peterson receives only $460,000 for the bonds and must pay $475,000 back. All right. So the difference between the two is $15,000 here. That $15,000 represents the additional interest expense to Peterson Machine Tool. Right. That's their explanation. I don't agree with it, with that explanation. All right. It's a matter of, I mean, it's correct, right? Let's see here, the difference between these two is 18,000 additional, right? But it's not a matter of, I think, you're paying the $16,625 in interest every single time that you're making, someone brings in the coupon and cashes in for their interest expense on the bond of 7%. The difference actually lies in the amortization of either the premium or the discount. Okay, and that's where the difference actually comes in. So you look at the two different amounts, and you can easily see that the discount, you're paying more in interest expense. The reason why you're paying more in interest expense is because because of your amortization of the discount versus the amortization of the premium. All right. With the premium, you're making money, and that offsets some of that expense. All right. So that's what causes the difference between the two. All right. And with that, I'm done with this problem. And again, go back and watch the theory videos. And if you still don't get it, feel free to contact an instructor.